So changing topics, I want to talk about two concepts. First is liquidity, and the word liquidity has two meanings in finance. The first meaning, the first definition of liquidity is something called corporate liquidity. And this refers to the ability of a corporation to borrow again to pay off last week's debt. And so corporations will often finance a lot of their activities using very short-term debt. This debt matures and they need to borrow again to pay off the previous week's debt. And so the 2008-2009 liquidity crisis refers to corporate liquidity. And later in this chapter, we'll look at something called the TED spread, and this will be a fairly good depiction of what happened during this liquidity crisis. But for the most part in this class, we're not going to talk about corporate liquidity. We're going to talk about asset liquidity. And asset liquidity has two dimensions. There's two dimensions to this term, this application of this word asset liquidity. The first is how much time is needed to get full price for an asset. The second dimension, the way to think about this, is how much do we have to drop the price to get immediate cash? And so what we're concerned about is asset liquidity. Let's think about this. How do I sell a used car? Well, I have two choices. I can put an ad online and I can wait for people to come to my house and decide that they like my car, and I just wait until somebody is willing to give me full price, and I'm going to have to wait a while. My second choice to sell my used car is to drive down to Federal and see Deal and Doug, and Deal and Doug is going to give me cash right away. But I'm likely to take a bit of a price hit if I want cash right away. So this is the liquidity trade-off for a used car. Wait to get full price, or get cash right away, but take a bit of a price hit. And now I can think about how liquid different types of assets are. A used car is going to have a certain amount of liquidity. A house is probably going to have less liquidity. 100 shares of Apple, I could sell 100 shares of Apple at what is effectively the most recent price, full price in a second. Maybe 10,000 shares of Apple. This might take a little bit longer. I might have to wait for more buyers to arrive at the market, or if I want to sell it, I might take a bit of a price hit. And we'll talk about how these assets are bought and sold. We'll return to all this information again in chapter 3 when we talk about markets, but for now I just wanted to define this idea of liquidity. First is corporate liquidity, borrowing again to pay off last week's debt. The second, and the one that's more applicable to this course, is asset liquidity. And we can think about this in two dimensions. And we can think about the liquidity of financial assets. We can think about how liquid a stock is. We can think about how liquid a bond is. We can think about how liquid a treasury bond is versus a muni bond. We saw a little bit of trading data on that earlier. Okay, now let's bring this discussion to a discussion of something called the efficient market hypothesis. Okay, let's talk about the efficient market hypothesis. And when people talk about the efficient market hypothesis, it's talked about almost like it's religion. I believe that markets are efficient, or I don't believe that markets are efficient, and hopefully we're going to come away from this discussion with a little bit more subtle understanding of this. And so what we're going to do is we're going to talk about the amount of information that is incorporated into securities prices. We're going to essentially have three forms of this hypothesis, each with sort of less restrictive assumptions about how much information is in securities prices. So we'll start with the strong form. And the strong form says prices reflect all information. If the information exists, then it is immediately incorporated into securities prices, and prices reflect that information. And so if this were true, if this holds, then what we would expect to see is that you can earn risk-adjusted abnormal risk-adjusted abnormal returns. You can beat the market only if you're lucky. You can't do it through superior analysis or through hard work or through skill. You can only do it if you're lucky. And so we will see some people beat the market, synonymous with this as risk-adjusted abnormal returns, and other people will do much worse than the market, but not in any numbers greater than we would expect to see if it were random. So we shouldn't earn greater than number of random, and prices won't react to announcements because as soon as that information is available, then it's already, as soon as that information exists, it is already incorporated into prices. And you can't earn risk-adjusted abnormal returns. You can't beat the market even with inside information. Now, this is likely not true because, well, we observe some of those things. So let's weaken the assumption and say that it's not all information that's incorporated into prices. It's all available or all public information that's incorporated into prices. So, for example, you have an accounting firm, internal accountants who are trying to figure out what the earnings are going to be for a quarter. There's some expected earnings. The earnings are computed. They exceed these expected earnings, but prices don't actually react to this higher number until it's made available. So, if this is true, if the semi-strong form is true, if prices reflect only available or public information, if it holds, then prices will react to announcements. When this number is made public, then prices react. And you can beat the market using inside and therefore illegal information. And lucky people will beat the market, but not in numbers exceeding what we would expect to see if it were random. And so this is this is an important point to understand this. If the semi-strong form of the efficient market hypothesis is true, then only lucky people beat the market, and we wouldn't expect to see them beat the market in numbers greater than what we would expect to see if it were random. And you can't beat the market with hard work because any information that you might find through hard work or through spending extra money to find mispriced securities, that's already incorporated if the semi-strong form of the EMH is true. The third is the weak form. And the weak form says that prices reflect only easily available or cheap information. So not all information, just a subset of that information is incorporated into prices. And so if this holds, we would still see prices react to announcements. So when easily available information is announced, like earnings that exceed some expectation, then prices will react. And you still can beat the market using inside and therefore illegal information. And lucky people will beat the market, but not in numbers exceeding what we expect to see if it were random. But you now can beat the market using difficult to obtain information, spending lots of time or money to acquire the information, or through superior analysis if you work hard. Okay, so again, the semi-strong form, you can't beat the market unless you have inside information. The weak form says you can beat the market, but you have to be using difficult to obtain information, which is whatever the opposite of easily available information is. You can't beat the market using easy information or non-superior analysis. So, there's good evidence that the strong form is not true or does not hold. Right? We see prices move when information which was previously known only to insiders is announced. And so prices do react to announcements. And we also observe that insiders do earn risk-adjusted abnormal returns. They do beat the market when they act on inside or illegal information. So the EMH only says, within the bounds of increasingly strong assumptions about the information processing of investors, that assets are fairly priced. And an implication of this is that on average, the typical market participant cannot earn excessive profits from a particular simple trading strategy. Now, easily versus all, that's where this becomes a little subjective. However, that does not mean that some individual investors won't outperform the market over some investment horizon. Certain investors who do well for a period get a lot of attention from the financial press, and so we tend to see these. But scores of investors who do not do well get considerably less attention. So the question is, are the results of investors like Warren Buffett evidence that markets are not efficient? Well, it's difficult to answer. And it may be the case that markets are semi-strong efficient and he's just lucky. And it may be the case that markets are weak form efficient and he just works really, really hard and is really, really smart. So maybe Buffett's results are evidence of the fact that markets are weak form efficient. You can't earn superior risk-adjusted returns looking at only cheap, easily available information. But that markets are not semi-strong efficient, meaning you can beat the market using public information, but only if you work hard and are smart. We also have to think about how markets arrive at these efficient prices. The argument is that market participants react quickly to news, but which market participants are reacting? And why should they bother? If markets are semi-strong form efficient, then there is no compensation for doing so. You're not going to earn any more than anybody else unless you're lucky. So why expend resources to position yourself to react to news if there is no profit? And so Grossman and Stiglitz, 1980, argued that since it's costly to process and trade on new information, in equilibrium markets can't be semi-strong efficient, but may move quickly to that state and then move back to an equilibrium level of disequilibrium, waiting for new information to arrive. What about VC, PE, and hedge funds? I mean, aren't they earning superior returns relative to other assets? Do they have inside information? Or do they have, not inside information, I apologize. Are they demonstrating that prices do not reflect all information, and therefore you can do this with more difficult to obtain information? Maybe. They seem to earn more. Is that evidence that semi-strong form does not hold and the weak form does hold? Maybe. The answer here is that maybe they just earn a higher return, which is compensating for super low liquidity. Remember that if I'm in a VC fund or a private equity fund or a hedge fund, I can't get out for a long period of time. And so they have very, very low liquidity, and maybe this is why they're earning more money. So again, not religion. The efficient market hypothesis just says that within varying restrictive assumptions about the information and prices, that prices reflect information. And the way that I tend to sort of think about this is you'll see someone on TV and they will say, of course markets are not efficient. This is why I'm so rich. If markets were efficient, then I couldn't make any money. And that's possible. They could be lucky. They could be just incurring a ton of risk. They're buying super, super risky stocks, and that's how they're beating the market. We'll talk about how we do risk-adjusted returns in a lot of detail later on. But it could also be the case that, yeah, markets really are weak form efficient, and this person is working hard, and they are actually earning risk-adjusted excess returns, profiting from information that's not incorporated into prices because it's not easily available or easily analyzed or something of that effect. So again, the efficient market hypothesis is not a 1-0. There are varying degrees. It is likely the case that the strong form doesn't hold. It is likely the case that the semi-strong form doesn't hold, because who would essentially make it semi-strong? But is it likely the case that the weak form holds? Is it only the case that people with superior information or superior knowledge, or who are going to commit actual resources, are they the only ones who are able to beat the market, or can anyone beat the market?